Welcome to the Push Ventures podcast, Push Your Advantage, and thanks a lot for tuning in. In our series, we're providing you with thought snippets on the African technology startup ecosystem. This is our last solo episode for the year, so we thought it fitting to call it a year-end summary and reflect a bit on what we perceived throughout the year. First, we'll talk about our event during which we hosted Ananth Narayanan early January in Nairobi. Then some highlights and disappointments, and what we like to see coming in the next year. Let's get started with our first topic. We hosted Ananth Narayanan in Nairobi. He's the founder and CEO of Mensa Brands, which is a company that has more than 25 brands across fashion, home, beauty, and FMCG, and achieved a net revenue run rate of $200 million while being profitable within a year. So it is unlikely to be a surprise to you that I say that within 6 months of operation, Mensa became Asia's fastest unicorn and second fastest to become a unicorn globally. For this event, we hosted all our portfolio companies in Nairobi and a few guests, and we had a really great exchange. You can watch the video for this on YouTube. I'm going to leave the link in this description, and you're going to see that there were a lot of great questions asked and also amazing answers given. And I think for everyone interested in the ecosystem and building businesses in Africa, it was a very good conversation that we had, and it was one where you can get a lot of insights into perhaps how you should operate your business. My biggest takeaway personally was that a relentless focus on unit economics is what steers everything that you touch. And that is also something that a lot of entrepreneurs this year, luckily also, experienced that they have to do. Let's go to the second topic. Some highlights and disappointments. Allow me to start with the highlights. First, I think it was very great to see that, portfolio companies managed to raise during this year, which has been perceived by many as a funding winter. And they managed to do so by being focused on execution, despite whatever headwinds they faced. And even when it came to the raise, by being focused on raising and also trying to find the right investors, the ones that still believed in the vision and what they were aiming at building over the long term. What we also enjoyed and was a highlight is that, some of the companies had to face this new reality. And unfortunately, it was also for them a harsh reality. And that is that business is there to make money. But they managed to really adjust to it and focus, as I mentioned earlier, even in the event, that the unit economics is what truly drives your business. And they adjusted and they got better because of it. And that was something which we personally, I and the whole company as a whole, which we love to see. What we further enjoyed was that some of those business models were very resilient and managed to grow despite headwinds. Some of the lowlights now. What we felt when you look at the news and when you're reading, for example, in Kenya Business Daily, you've seen that there was a lot of articles talking about how some of the businesses are struggling, how they're going out of business, or drastically scaling back from, being in several African countries to maybe just one. What we felt should have been promoted in one way or the other is some knowledge and experience sharing from those that went out of business. So it was more a quick article here, this is what happened, but a true knowledge and experience sharing by the founders, the people behind it. I think that would have been very interesting for every participant in the ecosystem, and we didn't find too much of that happening. I believe some of those failures also came from the founders not adjusting to those new realities of the environment, that funding winter that I mentioned before, and truly focusing on what does it mean to run my business, rather than just hiring a lot of people and always focusing on growth and telling a story. They didn't manage to adjust that their operation in the business and the numbers which come out of it is what drives everything in the business. What was another lowlight is that we felt some of the founders also were not looking to work well with the people that put their faith in them. In the end, it's business after all, but when investors come and when people put their faith in you, they give you money and they believe in your vision and they want the best for the company and for essentially helping to accomplish your dream together, then it is not great for people when it's not easy to work with people. And during those downtimes is usually when, as I mentioned before, when you focus and you refocus your energies on making sure that your business is sustainable, that it's operating well, and that you can grow out of whatever headwinds you have, because then you're stronger for the next coming phases of growth. And when it's difficult to work with some people, despite people having the best of intentions, that's something we did not enjoy so much. So we could summarize this as a year of pride and reckoning, a year of faithful and relentless focus on execution on one side, and also a year of neglect and ignorance on the other. But in the end, it was an interesting year, and an interesting year to really be on the ground and see how the startup ecosystem is doing. And despite whatever you might have read in the newspapers, startups have adjusted to the new reality. And most of the startups are also focused on how do we grow and get better. And that is the best thing to see during this year. What we'd like to really see in the year to come, and what we'd like people to focus on, is to have this reality check and really focus on the terms. So investors should be more savvy about the terms on the one side as well of the investment, but also on the valuations. And here again, our mantra is always, as long as you have the right investors and they can work with you and you can work with them well, then valuation, while it is important, I'm not saying it's not, but it can also be lower during a tough time like the one we had this year. And if you have the right people, they will help you build your business and grow your business and also reward you in the process. Unfortunately, in the past, oftentimes we've seen that terms are handpicked by the founders, and lead investors did not always set the best terms for all parties involved. So we really would love to see that the lead investors focus on that respect for the investor money that they are looking after and the value of time of that money, and negotiate great terms for all parties involved. Then we also would like to see a renewed focus on governance. Some companies are doing this very well. Some have great boards in place. But always remember that not every company has that. And especially the companies which are focused and which are early, they need to focus on building these boards with the right people. And when you build a great board, you have a very good party which will put you on the right path, which will share experience and knowledge with you, and which will make sure that your company is well run. And particularly during a year like the last one, a well-run company is very important because it's easier to address whatever challenges will happen. And every business has challenges along the way. But if you have a well-run company and a good board, it's easier to address those challenges. We further see that some of these interest rates will force over time an adjustment in valuation. Interest rates have gone up tremendously in the West, and they've also gone up locally in Kenya. And that exchange rates, which have depreciated quite a lot, will add pressure to this as well. So in the end, because obviously with the new exchange rates, if you were making 100 shilling before, that used to be $1, now it's not quite that. But we also believe, and what we also see, is that African venture capital will not stop. But the global pressures are likely not going to ease too much during the next year. So we started this podcast series with the opinion that we are definitely bullish on companies and the ecosystem in Africa as a whole, and we remain long-term bullish. But we are also short-term skeptic, and at the same time, always remember, long-term bullish does not mean that we buy everything at whatever price. It means that we're bullish on the ecosystem as a whole and on the economics and on the companies that can be founded here. But it also means that we are focused on what you're building on a micro level, what truly your company looks like. And that brings us also to the summary. And I think in summary, this year started off with the phrase focus on your unit economics. And I kind of like to also use this as the phrase for the year to define it, because it is a focus on your unit economics. If you focus on that, you can build a great company. And to add to that, keep on executing relentlessly whilst extending your runway as long as possible. Because if you have to race, also race and go out early. It's always good to do that because you don't know how long it will take you to actually raise capital. With that being said, we wish all of our listeners a Merry Christmas and a very happy New Year 2024. You can find us on YouTube, Instagram, and Facebook as Push Venture Capital, on Twitter under hashtag #PushYourAdvantage. And we'll be back in the next year with more podcasts on the African tech ecosystem, which are available on Spotify, Apple Music, F-Reports, and of course, YouTube.